What if you could buy real estate with, like, infinite money? It sounds like a cheat code, right? Well, that's because it is. And today, we're unlocking the single most powerful strategy that separates the amateur investors from the pros who are out there building massive portfolios. I want you to think about your first deal for a second. You poured your life savings into it, you closed, and you felt that incredible rush. But then, a week later, a new feeling starts to creep in, doesn't it? Is all my cash now trapped inside the walls of this one property? This, right here, is the #1 reason investors get stuck. You put everything you have into one great deal, and suddenly, your momentum just grinds to a halt. You're completely out of the game, stuck on the sidelines, sometimes for years. But what if that one deal could fund the next one? And that deal could fund the one after that, and so on. What if you could create this repeatable machine that lets you buy property after property without ever running out of your own cash again? That's exactly what we're going to break down. Okay, so the entire mechanism, the engine of this whole infinite loop, is something called the cash out refinance. Now, this isn't just another loan, it is the key that unlocks the value that you yourself have already created. So here's the crucial point. You're getting a brand new loan, but it's not based on what you paid for the property. No, it's based on its new, much higher after repair value, or ARV. This new loan pays off your initial financing, and this is the most important part, it lets you pull your original cash right back out into your bank account. And this is where the magic really happens. You're getting a loan based on that higher ARV, which completely wipes out that expensive short-term money you probably started with. You get your original cash back to go find the next deal. But here's the real kicker. Because it's considered loan proceeds, not income, the capital you pull out is completely 100% tax-free. All right, so how do you make sure the bank actually gives you all of your money back? Well, it starts by understanding the first rule of their game, a metric called loan-to-value, or LTV. LTV, loan-to-value, is actually pretty simple. It's just the percentage of the property's appraised value that the bank feels comfortable lending you. And for us as investors, that sweet spot is almost always between 75 and 80%. You gotta know this number because it dictates everything. So let's make the math real. Let's say you do a great job on the renovation. You force the appreciation, and now the property is worth $350,000. If the bank's LTV is 75%, the maximum loan you can get is this number right here, $262,500. Now, if your total cost for the whole project was less than that, you've just done it. You've recycled 100% of your capital. But this brings up a huge question, a roadblock for so many people. You've got a great deal, but you go to a conventional bank, and they look at your personal finances and say, sorry, your debt-to-income ratio is too high. Your job can't support another mortgage. So, are you stuck again? Nope, because you're not going to play their old game. You're going to use the investor's cheat code, a totally different type of loan with a completely different set of rules called a DSCR loan. And this chart just lays it out perfectly. See, a conventional lender, they care all about you, your job, your personal income. But a DSCR lender, honestly, they could not care less about your W-2. They have one single focus, the property. Does the asset itself generate enough income to pay for its own mortgage? That's it. And that's all DSCR means, debt service coverage ratio. It's just a fancy way of measuring if the rent coming in is more than the mortgage payment going out. Most lenders, they want to see that the income is at least 1.25 times the debt. It just proves that the deal can stand on its own 2 feet. So forget your tax returns. Forget your pay stubs. This right here is the only question that matters to a DSCR lender. If the answer is yes, you get the loan. It's that simple. And this is how you scale a portfolio, because the limiting factor is no longer your job, it's your ability to find good deal. Now, you might be thinking, wait a minute, if I take out a bigger loan to get all my cash back, my monthly mortgage payment is higher, which means my monthly cash flow is lower. And you're right, that's true. But it's a strategic choice you're making. Look, you have a choice. You can absolutely maximize the cash flow on this one property by leaving some of your cash in the deal. Or you can pull every last dollar out to maximize the velocity of your money, letting you go buy another property and then another. The goal isn't to get rich from one house, it's to build a portfolio of many houses and to do it fast. But I have to be straight with you. This strategy is not without risk. And if you don't know the pitfalls, this refinance step can turn into a total nightmare that traps your capital for good. So let's talk about what can go wrong. These are the absolute deal killers. A low appraisal, getting blindsided by thousands in closing costs you didn't expect, or finding out the market rent isn't actually high enough to satisfy the lender. Any one of these can completely derail your plan and trap your cash in that deal. Let's just focus on the biggest one, the appraisal gap. If you were banking on the property being worth $350K, but the appraiser comes back and says it's only worth $320K, your 75% LTV loan instantly drops by this much, $22,500. That's cash you thought you were getting back that is now stuck. So here's rule number one for how the pros protect themselves. They never run their numbers assuming a perfect outcome. They build in a 10 to 15% buffer. They analyze the deal as if the appraisal is going to come in low. That way, if it does, they're still safe. And if it comes in high, well, that's just a bonus. And to make sure you're totally prepared, here is the exact checklist a DSCR lender is going to want to see. You need a signed 12-month lease. Not month to month, they need to see stability. You need your proof of insurance, of course your LLC documents, and critically, recent bank statements showing the tenant has actually started paying rent. Have this ready, and the whole process will be smooth as silk. So, you've done it. You successfully pulled out your capital tax-free, and you're ready to go find the next deal. This is how you build a portfolio. But using this powerful tool, it really opens up the next level of thinking, doesn't it? How does this fit into a bigger, long-term strategy to build generational wealth? This is the Brick by Brick channel, where we help beginners build wealth real estate one brick at a time. If you got value from this, hit the like and subscribe for weekly investor breakdowns.